friends. Welcome back to another Random Gleanings. You know Chris and myself. Today we've got a very special guest. You may have seen him last week where we rolled out Bryce Gill. I came in with a sport coat and my hair done up, and he showed me up. He's got some gator boots on and a sweet mustache. So, Bryce, today our thought was that we were going to cover a kind of where you are and where First Trust is in forecasting 2024. And rather than try and guide that conversation, I'll let you take it away just because I'm very interested in what you all are thinking.
Okay, well, absolutely. And by the way, thank y'all for having me back. It's great to be back with you. So, hey, heading into 2024, I think we've just been in an era of volatility, ever since the pandemic, really, right? And what's really driven that is the increase in interest rates, the change in the inflation paradigm, okay? And so as we head into next year, I think the current narrative is we've pulled off a soft landing. We vanquished inflation. And on both those fronts, I'm skeptical, right? So it's not that I think inflation is going back to 10%, but I think we could easily see that headline measure rebound. And just underneath the surface, I think inflation is going to remain sticky. It's going to remain above the Fed's target of 2%. And on top of that, I am expecting some sort of a recession next year. And so essentially what you've got is continued volatility on the long end of the yield curve, right? Interest rates bouncing all over the place. And then concerns about an economic slowdown on top of that. This is not the recipe for like a new bull market starting, right? So does it mean we're going to sell off 50%? No, of course not, right? But I do think we're going to see the stocks that outperformed in 2023 potentially, underperform, and then hey, a rebound in those names that have kind of been unloved as they weather this storm of volatility a little bit better. So a little bit of a rotation. And that's what we've seen the past couple of years, right? Is one asset class does good, one does bad. And then this year we've had the exact inverse of that. So I think we could just basically keep bouncing around here. And big picture, we look back on this era and the market's just kind of flat overall. Stocks don't do much. Great time for fixed income, obviously. But hey, we've got some I think trouble underneath the surface here.
So you mentioned the Fed's target of 2%. One of the conversations that Chris and I have is, are they being too dogmatic about because they have been very firm. They want it back at 2%. Is there any range from an economist standpoint of which 2.5 or 3.5 is a viable long-term inflation rate, or is it really need to be back down to that 2%?
Yeah, it's an excellent question. I think what I would say is, listen, the 2% inflation target, this is not passed down from Mount Sinai to Moses on the tablets, right? Like this became a thing in 2005. It was publicly communicated. And so I think what's really important to illustrate here is they were looking at the 20-year period, 1990 to, I guess, 2005, that's 15 years, right?
Right.
They were saying, hey, this is the new normal. Inflation's been low and stable at 2% for 15 years. This is the status quo now. And my problem with that was this was occurring during the biggest boom in globalization in modern history.
And not to mention the greatest boom in disinflationary technology being produced. Like nobody in 1990 had a computer on their desk looking at email, right? Like 15 years later, I didn't get a computer on my desk with email until 1998, okay? And nobody had a BlackBerry, let alone an iPhone in that time period. That's massive.
Production gains.
Yeah, productivity, disinflation, all aspects. So why now, if someone in West Africa has an iPhone or an Android device and they can communicate efficiently with the world, doesn't that kind of imply that ultimately that those disinflationary downward pressures aren't there as much anymore?
Right. Yeah. I think that's definitely true. Like the technology that we have, the iPhone, smartphones have become ubiquitous, right? We've sort of seen that part of it play out. Now the next stage, obviously everyone talks about AI, things like that. And that probably will happen, right? I'm optimistic that we will continue to automate and use technology as a species to increase productivity. Like all of history says.
You mentioned last week, demographic changes that will maybe hamper some of this, but maybe AI steps in as part of that productivity gains that are lost in some of the demographic changes. Is that accurate?
Yeah, that's absolutely right. So, people give Paul Volcker credit for solving inflation in the early 1980s by just high interest rates. I don't personally think that's what solved inflation in the long term. Okay, I think that was more about actually defending the dollar's reserve currency status. The dollar selling off in international markets because we went off the gold standard. We had a massive energy crisis due to the OPEC oil embargoes. You pay people 20% to own a dollar, like it incentivizes them to hold them, right? So I think that was a big reason interest rates got as high as they did. Why I'm not worried about them getting as high this time around. I think how we ultimately solved inflation is instead of paying an American to produce something, you pay someone in China 5% as much an hour to produce it, right? So globalization, cheap labor is how we fixed inflation, in my view. Now we've basically seen that trend come to an end.
And being reversed.
Exactly,
now, right?
being reversed. And just it's important to note, there is no cheap labor left, right? It's drying up everywhere. So it's not just now we go to Africa or something. I mean, you could, but Africa doesn't have infrastructure. Africa has massive political problems. Like you go down the list. And so I think the trend going forward is more and more reshoring, more and more the United States producing for itself. And yeah, that's going to have inflationary consequences, right? And ultimately, if we can't outsource to fix the problem, well, then you have to use technology to boost output per hour. That's the deflationary, solution.
All right. So as you think about 2024, I mean, so far we haven't seen anything show up really in those, continuing claims for unemployment insurance. And I mean, that's usually like one of the big tip-offs that something's coming. And ironically, if you look back through history, I mean, we've talked some about history hasn't applied in a number of things. I got a couple questions actually to ask you about that. Usually when the Fed starts to signal rate cuts, which they did yesterday, usually within a couple, 3 months, you start to see some unemployment claims mildly tick up, which is usually kind of one of those sort of, tip you off towards something slowing down a bit more. What are your thoughts on the unemployment rate? I mean, it's been sub 4 forever now. I mean, continuing claims haven't, clipped up at all. What are your thoughts on unemployment?
Yeah, so I'm expecting a recession. I do expect unemployment to tick up a little bit, but one of the reasons why I'm sort of optimistic this is going to be a mild recession overall is I do think pre-pandemic, we had a certain baseline demand for U.S. labor, right? And then all of a sudden, hey, post-pandemic, we're reshoring, we're hiring American workers to make the same stuff. Demand for U.S. labor just has like an upward shift, right? And I think that's kind of where we're at. Businesses continue to hoard labor. The labor market has remained very, very strong. And so, ultimately, I think unemployment will go up, but it's not that there's no demand for U.S. labor anymore. It's just we're shifting people in between industries. There's sort of like some frictions there, moving them between geographical areas. And so I actually don't, see an either or situation, right? I think you can't have an unemployment rate tick up where structural demand for U.S. labor is still pretty strong. So I think that's a good thing for the country, even though we have like a short-term issue to go through there. And yeah, you mentioned, hey, you look at stock returns, and historically, when unemployment's very low, they're not as good, right? And the reason why is, the unemployment rate is always the lowest before it starts to rise, right?
Right.
And so, the magnitude of the increase is important here. I don't think it will be very big, but yeah, I don't think we can just stay at 3.7% forever, right?
Yeah. So, okay, second question then, the other thing, sort of, the norms. I mean, anytime the 10-year Treasury and the 3-month T-bill have inverted, I mean, usually within 13 to 18 months, you're in a recession.
Yep.
13 months was November last month, right? And 18 months would be, I think, April-ish timeframe, right? So it's still inverted. Actually, it's more inverted today than it was a week ago.
Yep.
So,
or a year ago.
Or a year ago. That's
that
right.
matter, right.
I mean, and if you go back to 1970, that 10-year, 90-day T-bill inversion has a batting average of 1,000 for a recession.
Right.
Now, this could be the one, right, where it isn't. But, I mean, how do you square this? It just continues to be, it's like there's this party going on out there in the stock side of things. And in the bond side of things now, I mean, it kind of looks like a party too. I mean, the 10 years rallied like mad in the last 3-4 weeks. So, I mean, what do we do with all this, with this information, with the inversion in the bond market?
Yeah, so I guess first I'll start, hey, why has this indicator not hit? It's hit every other time, right? So I think it's important to understand, hey, in a market economy, what do prices do? They coordinate the means of production, right? Prices are not just numbers, they're actually signals of what's going on the production side of the economy. And so when you think about prices in the economy, the price of money is pretty important. It's maybe the most important price. And what we've seen over the past 15 or so years is that the Federal Reserve after 08, 09, I don't want to say nationalized the entire yield curve, but they were playing such an outsized influence in the purchase of government debt that those prices just lost meaning. They didn't really have any information they were communicating anymore. And especially after COVID, they're buying like 80% of Treasury issuance at one point, right? And so I think the price signals that we were getting from the yield curve were just completely thrown out the window. I don't think it was a very good indicator.
In this time frame right now, or in the last few years before COVID?
Yeah. So in the last few years before COVID. Okay. And that's the interest. That sort of gets me to now answering this question, which is, hey, the yield curve's still inverted. How do we see this all shaking out? Okay, I think essentially what we're going to see is the Federal Reserve will cut interest rates next year because I think we're going to have a recession. Unemployment goes up, they're going to cut. Okay, but they're not going to be able to go back to zero. That playbook's gone because of the inflation that was sparked. So I think the short end of the curve, interest rates are going to fall a little bit. At the same time, okay, the long end of the curve is now driven by market-based factors. The Fed is no longer playing that outsized role. The bond vigilantes, people may have heard of this term from the 1980s, are back, right? And so I think what we ultimately see is interest rates on the long end of the curve rise, short end of the curve fall. That's where you see the steepening. And I guess the catalyst for this would be a recession in the United States, right? So it's also important to think like, hey, why would the Fed cut interest rates? If the economy is just humming along and inflation is falling, either like, hey, we're back below 2% for 6 months, or we're having a recession, that's what would cause them to do what we would call the pivot. That word's sort of gone, right? But that's ultimately, I think, what causes the shift here with the yield curve. So I think it ends up being correct eventually. It's just like a broken clock is right twice a day. Like how valuable is this indicator? I think it eventually will become more valuable now that market-based signals are returning to the maturity schedule of government debt.
Is there? I mean, the credit spread between treasuries or the risk-free rate and high yield bonds is virtually non-existent right now, right? What signal does that show for you right now? Does that show persistence in optimism, or is that just skewed as well?
Yeah, I guess that's sort of like an anti-recessionary indicator, right? Those spreads start to blow out because you've got companies that have obviously risk associated with lending to them, whereas the U.S. government, there's not really risk. It's the risk-free rate for a reason. So you'd expect to see like a risk premium on high yield debt that doesn't exist right now. And so, once again, I think just a lot of these interest rates have just been completely distorted due to the massive pandemic measures. And ultimately, I do think we see that spread widen. It probably happens when recession starts to show up, would be my guess.
Do you buy the notion that, government debt means that the quality of that debt currently is not as good as it used to be, and maybe corporates are stronger than they used to be? Is there any credence to that?
Well, I think in 08, 09, what we essentially saw was deleveraging on private sector balance sheets, right? Companies and households paid off debt and started increasing their savings. And this essentially transferred to the government instead, right? Now the government has a very out of whack balance sheet. And so, yes, like corporate bonds, corporate debt looks pretty good to me. A lot of these companies have a lot of cash on hand. Like their business looks good overall. I don't think we're going to see a mass wave of like public sector defaults or public market defaults, I should say, because bankruptcy data is rising, right? I think a lot of the small businesses that were kept alive by PPP loans are now starting to go out of business.
Right.
Bankruptcies are up 20% in the past year. It's the biggest increase since 2007. So there are certain indicators that are also recessionary showing up underneath the surface. But yeah, like public market corporate debt, it seems fine to me. Government debt, they're never going to default on it. They'll just print money. Right. That's why it's the risk-free rate, right? You get your nominal dollars back. It's just, what are they worth?
So do you have, what could go right next year? If we think about like the right tail of things, what do you see that could be, a really positive catalyst going into next year?
Yeah, I think the labor market remains very strong. I think that technology comes in and solves a lot of the productivity issues, right? Helps reduce price increases. Maybe we see, a lot of these conflicts around the world resolved. Somehow we get, a resolution between Russia and Ukraine, and the United States is able to reopen trade with Russia. We have an abundance of natural resources from them again. China and us, we pave over our problems, and we're right back to the old days of globalization, right? I find it hard to sort of square that circle, though. It seems to me, as a student of history, once the snowball starts rolling downhill, it picks up momentum, right? And that's what we're seeing across the world. It started out with COVID, then Russia invades Ukraine. Now it's Israel-Palestine. Then, these things feed on each other. And that's unfortunate, I think, the direction things are going.
So, we talk about that snowball, and we talk, if you look at the current administration, next year's an election year. So we talk about the current administration. They've been pretty tough on like the Israel-Gaza thing going on. Certainly the previous administration wanted to sort of renegotiate some of those disadvantages to the United States historically. So it seems like both parties are like you say, with the snowball kind of there. What type of implications do you think the election has next year? And, what does that mean for markets?
Yeah, absolutely. So, it's interesting because 2016, Donald Trump is elected, right? He really brings to fore a lot of this, I guess you'd call it like nationalist politics, becoming less dependent on foreign countries, right? Reshoring, all this stuff. And now you look, and this is just the status quo for both political parties, right? We have actually seen a huge change in, we call it like the Overton window or whatever, right? Politically. So I think people have been realigned by COVID in the direction of like the original Trump administration. And so the Democrats are kind of on board with a lot of this stuff as well now, which is very interesting. And so my view of politics overall is I think that the figurehead in there is kind of irrelevant. I think it's mostly just the words and the way you sort of describe a similar thing that's going on. It's more of like the wheel of history turns, and they kind of follow along. They follow the culture. And I think the culture has shifted more towards nationalism, self-sufficiency, reshoring. I think that's going to continue to be what happens going forward. And despite who gets into the White House, I think you're going to see more confrontations with foreign countries over trade deals, over conflicts around the world. I think taxes are going up no matter who's in office, right? We tend to sort of look at, as Americans, like it really matters if my guy gets in or doesn't. And I think it's like the wheel of history turning that really matters more. And it's just kind of like who's going to be the figurehead telling you how to think about this.
Right. Does the reshoring have market implications that are positive just because of all the money that's going to be spent on research development and
infrastructure?
Yeah, infrastructure.
Yeah. So I think basically what this has done is after 08, 09, it was 0% interest rates. It was cheap labor. It was free money, all this stuff. That's great. Just buy an index fund. Like every stock's going to go up pretty much under this scenario. Now it's sort of like a stock picker's market, right? So there's a ton of opportunity out there right now, but you're not able to just use like a robo-advisor or like an index fund anymore. I think financial market professionals are adding more value today than they have at any point in my career and probably any time in the past 20 years, right? So is there opportunities that are come with this? Absolutely. But there's going to be more work and due diligence that goes into it than just buying an index fund.
Can you manufacture a semiconductor in an abandoned office building? That's
whoever figures that out is going to be the new Elon Musk, right? The new billionaire.
That's for sure.
That's indeed, right. Yeah. Indeed. All right. Final question from my perspective: who can better pull off a handlebar mustache, Jesse or me?
Oh, man, that's a great question. He's already got the mustache going, but
that's
I
right.
actually think looking at your face with like the glasses, you would look better with the handlebar mustache than he would.
All right.
I think he's the beard guy.
That's right.
How could you get rid of the salt and pepper
there you go.
color in the beard?
Shows a little wisdom. That's right.
That's right.
Yeah. I, ironically, with the last name Beard, it's kind of a struggle to get that
to
come
pull
on.
that off.
So.
That's funny.
Jesse, do you have anything else?
I don't. Bryce, thank you so much for being here.
Yeah, we're
absolutely, guys.
We're absolutely grateful to you for spending this time the last 2 weeks with us. It's awesome. Thank you again. Thanks as always for watching. We're grateful to you. Please do click the subscribe button and click the bell to be notified when we post. It comes up in your little window down at the bottom corner. It's really good to have that. And of course, Bryce is here with us, sharing some awesome thoughts. Please do share with friends. We're grateful to you again for watching, and Happy New Year to you. Thanks.